We're jumping straight into Robin Energy today. Everyone is watching the price action. But the real story is their aggressive fleet expansion into high-margin liquid petroleum gas.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds, hit that subscribe and like button. It really helps us simplify the market for you every single week.
Yeah, please do. It makes a big difference.
So, to really understand what is happening with Robin Energy today being March 3rd, 2026, we have to wind the clock back slightly, just to yesterday morning.
Right.
Because we are looking at a stock that closed on Friday, February 27th, at a very quiet $4.05.
Super quiet.
Yeah. But then Monday morning hits. Before the opening bell even rings, the stock surges to $5.48.
It's crazy.
I mean, that is a 35% jump, essentially, overnight. So, how does a move like that even happen before the market officially opens?
Well, pre-market trading is a completely different beast compared to regular trading hours. The volume of shares changing hands is it's incredibly thin.
Because most people aren't awake yet.
Exactly. Because there are fewer buyers and sellers, it takes a lot less money to push the price around. But a 35% gap up that actually holds its value, that isn't just a handful of retail traders waking up early.
Right, it has to be something bigger.
Much bigger. When a stock moves that violently and doesn't immediately crash back down at the opening bell, it leaves a very specific footprint. It points toward heavy institutional-grade buying pressure.
So somebody with serious capital is accumulating shares.
Yeah. They are either anticipating a major technical breakout or getting ahead of a fundamental shift that the broader market just hasn't noticed yet.
Well, let's figure out what that fundamental shift might be, because Robin Energy isn't exactly a company with a 50-year history on the water. Where did they actually come from?
They are a newly independent entity. They completed a spin-off from Toro back in April of 2025.
Okay, so they haven't been on their own for very long.
Not at all. But as part of that separation, Toro provided them with a very healthy cash infusion for working capital. So they began their life as a standalone company, well-capitalized, but almost entirely invisible to the broader investing public.
Why do spin-offs tend to be so invisible early on? I mean, you'd think the market would pay attention to a brand new capitalized company.
It comes down to structural market mechanics. Spin-offs often become what we call orphan stocks.
Orphan stocks.
Yeah. Imagine you are an institutional investor holding shares of Toro because you like their specific business model. Suddenly, you are handed shares of Robin Energy.
Which is a smaller, completely different company.
Exactly. You didn't ask for those shares, and they might not fit your portfolio strategy at all, so you sell them.
Makes sense.
And a lot of investors do the exact same thing simultaneously. That artificially depresses the new company's share price right out of the gate.
So the market just ignores the new company's actual potential because everyone is so focused on offloading the shares they didn't even want.
Precisely. But eventually, the selling pressure exhausts itself. The new company starts executing its own strategy, and the market wakes up. That overnight surge we just saw strongly suggests the wake-up call is happening right now.
That brings us to the actual business model. What did they do? When they separated from Toro, they started with a very modest setup.
Very modest.
They had just one vessel, the Wonder Mimosa. The filings described it as a handy-sized tanker with a 0.03 million deadweight ton capacity.
Right.
So for those of us who don't have a maritime engineering degree, translate those specs.
Let's break that down. Deadweight tonnage is simply the absolute maximum weight a ship can safely carry before it sinks.
That's a pretty crucial metric.
Definitely. That includes the cargo, the fuel, the fresh water for the crew, everything. It's the standard metric for a ship's earning potential.
And the handy-size part.
Think of a handy-sized tanker as the heavy-duty pickup truck of the ocean.
Okay, I like that analogy.
It's not a massive, lumbering supertanker that can only dock at specialized deepwater terminals. It's small enough and nimble enough to enter almost any standard port in the world.
Which gives them a lot of options.
It does. That flexibility makes them incredibly useful for regional trades and shorter routes.
But operating a single pickup truck, even a heavy-duty one, comes with a lot of overhead.
Oh, yeah.
You need a dispatch team, mechanics, route planners. How does a microcap company run a single ship without drowning in corporate expenses?
Well, they didn't even try to build that corporate infrastructure. Instead, they took a much smarter route and placed the vessel into an unaffiliated tanker pool.
Wait, how does a tanker pool actually function?
Think of it like a rideshare network. but for multi-million-dollar cargo ships.
Okay, I'm tracking.
If you drive for a rideshare app, you don't build your own marketing department or write your own routing software. You plug into an existing network that finds the passengers and tells you where to go. A tanker pool does the exact same thing. Robin Energy hands the operational scheduling of the Wonder Mimosa over to a pool manager.
So the manager is pulling the strings.
Yeah, the manager combines Robin's ship with vessels from other companies, creating a massive virtual fleet. The pool negotiates the charter contracts, finds the cargo, and optimizes the routes globally.
And Robin Energy just collects a check.
Pretty much. Robin Energy gets a share of the total revenue generated by the pool based on their ship's contribution. It stabilizes their income and keeps their corporate overhead phenomenally low.
That makes a ton of sense for the starting line. But the market isn't reacting to a single handy-sized tanker today.
No, definitely not.
The real catalyst here is their recent fleet expansion. They went out and acquired 2 modern, Japanese-built liquid petroleum gas carriers.
The Dream Cyrax and the Dream Terrax.
Right, and these are rated at 5,000 cubic meters each. Why pivot away from standard oil tankers into liquid petroleum gas?
The transition from crude oil to liquid petroleum gas, or LPG, completely rewrites the company's margin profile. Transporting crude oil is a commoditized, highly saturated market.
Lots of competition.
Tons. Anyone with a steel hull and an engine can move oil. Transporting LPG is an entirely different engineering challenge. You are dealing with a gas that has to be pressurized or severely refrigerated to remain in a liquid state during transit.
That sounds a lot more volatile.
Highly volatile. The safety protocols, the specialized containment systems, the crew training, the barriers to entry are massive. You can't just retrofit an old oil tanker to carry LPG.
So the supply of ships that can actually do this is pretty limited.
Exactly.
Wow.
Because fewer companies have the capital and the expertise to operate in this space, the supply of specialized ships is constrained.
And when supply is constrained and demand is high?
The charter rates you can charge customers carry a significant premium. Robin Energy is deliberately positioning itself in a much higher margin segment of the shipping industry.
You mentioned high demand. Where's this gas actually going?
The demand is being driven structurally by the Asia-Pacific region. We are seeing a massive multi-decade transition in that part of the world.
Really? Like residential or industrial?
Both, actually. On the residential side, hundreds of millions of households are moving away from burning biomass or coal for cooking and heating, shifting toward cleaner burning LPG.
And industrial.
On the industrial side, massive chemical manufacturing hubs are retooling their plants to use LPG as a primary feedstock instead of heavier, dirtier fossil fuels. Robin Energy isn't just buying random assets, they were skating to where the global energy puck is going.
Which makes the information void around this company even more fascinating to me.
Well, the blind spot.
Yeah. If you run a search for Robin Energy on any standard financial news terminal right now, it is a wasteland. You just see automated, generic headlines like 12 industrial stocks moving in Monday's pre-market.
Nothing of substance.
Right. Nobody is publishing articles about the Dream Cyrax. There is zero mainstream analyst coverage. Why is Wall Street completely ignoring a company making these kinds of specialized asset plays?
Wall Street analysts operate on incentives. Covering a micro-cap spinoff on day one just doesn't pay the bills.
How so?
Investment banks have strict market capitalization minimums for their institutional clients. If a stock is too small for a major mutual fund to buy without moving the price, the analyst simply won't spend the time writing a 50-page research report on it.
There's no upside for them.
Exactly. There is no bonus in it for them.
But that blind spot is the actual opportunity for individual investors, isn't it?
Precisely. Operating under the radar is a massive bullish setup when a company is already showing signs of institutional accumulation. Eventually, the company grows large enough to cross those market cap thresholds.
And then the analysts swoop in.
The moment a prominent investment bank publishes that first comprehensive research report, the moment they break down the LPG margins and the fleet expansion for the broader market, you see a classic small cap re-rating.
Because the market finally sees the real value.
Right. The market stops valuing the stock as an obscure, forgotten spin-off and starts valuing it based on its actual high-margin cash flows.
Yeah.
Early investors who do the homework before the analysts ring the bell capture that re-rating upside.
Speaking of doing the homework, I want to look at how they are paying for these new ships.
Mm-hmm.
A newly independent microcap company doesn't typically have tens of millions of dollars in the sofa cushions to buy modern Japanese gas carriers.
No, they don't.
Are they just taking out massive bank loans?
Not exactly. They are relying heavily on the equity markets. Over the last year, management has utilized multiple registered direct offerings and underwritten public offerings.
Okay.
They are raising capital under what are called effective shelf registrations.
What does a shelf registration actually allow them to do?
Think of a shelf registration like having a pre-approved credit line sitting on a shelf at the Securities and Exchange Commission.
Just waiting to be used.
Exactly. The company has already done all the grueling regulatory paperwork to issue a specific amount of new stock. It just sits there, inactive.
But when they find a ship they want,
The moment management spots a specialized ship they want to buy, they don't have to wait 6 months for regulatory approval. They pull that registration off the shelves, instantly issue new shares to institutional buyers, click the cash, and buy the ship.
wow.
It allows them to be incredibly agile and aggressive with their capital deployment.
Okay, you've painted a beautiful picture of a cash-printing, specialized fleet using clever financial tools to grow rapidly.
It does look good on paper.
But I know there's no such thing as a free lunch in the shipping industry.
Let's look at the flip side of this aggressive growth. Where are the trapdoors here?
The most immediate hurdle is execution risk. The business model they are building is largely unproven at this new scale.
Because they're deploying so much capital.
Right. They are buying these specialized LPG carriers, but the high margins we just discussed are entirely theoretical until they actually hit the income statement.
Because shipping rates aren't guaranteed forever. Exactly. Shipping is a notoriously cyclical and volatile industry. If global macroeconomic conditions weaken, or if that Asia-Pacific demand suddenly cools down, the daily charter rates for LPG transport could drop.
And they still have to pay their bills.
Yes, these modern gas carriers come with very high fixed operational costs. You have to maintain the refrigeration systems and pay specialized crews regardless of what you are charging the customer.
So if charter rates compress,
Those high fixed costs remain, and the math turns upside down very quickly.
and verifying that math brings us to a massive structural problem for anyone analyzing this stock right now. We have a serious missing data gap.
A huge gap.
Because of the timing of their spinoff and their reporting schedule, we are missing crucial financial details. We don't have granular 2025 revenue figures.
Yep.
We don't have forward-looking earnings guidance, and perhaps most dangerously, we don't have a clear, updated view of their debt profile. Evaluating this company right now feels a bit like buying a house without being allowed to see the inspection report.
That is a perfect analogy.
The paint looks great from the street, but you have no idea if the plumbing is leaking cash behind the walls.
Without the latest annual or quarterly SEC filings, those comprehensive documents that break down every single line item investors are genuinely flying blind.
What do we actually know for sure?
We know Toro gave them a cash infusion.
Yeah.
And we know they've raised money through stock offerings.
But that's about it.
Right. What is their actual daily cash burn rate? What are the precise operating expenses of these new Japanese vessels? We just don't know yet.
And when you lack the hard numbers to validate the growth narrative, you have to demand a higher risk premium for holding the stock.
Absolutely.
Let's circle back to how they are getting their money too, because those shelf registrations you mentioned earlier introduce a very real threat to current shareholders.
Dilution.
Dilution!
Relying on equity financing to fund aggressive expansion is a double-edged sword. Every single time Robin Energy pulls that registration off the shelf and prints new shares to buy a ship, the total number of slices in the company pie increases.
That means your individual slice, your ownership percentage, gets smaller.
Yes, it shrinks.
It also raises a red flag about their balance sheet, doesn't it? If the ships are such great assets, why aren't traditional banks lining up to finance them?
That is the structural weakness you have to look out for. Pumping out multiple share offerings might indicate that traditional lenders view the company as too risky for standard debt.
So they get locked out of the debt markets.
If banks aren't willing to offer loans at reasonable interest rates, the company has no alternative but to keep returning to the equity well.
What's the worst case scenario there?
The real danger happens if shipping rates drop and they suddenly need emergency operational capital. Raising equity when your stock price is falling requires issuing massive amounts of shares just to get a little bit of cash.
That sounds like a death spiral.
It can be. That creates a compounding cycle of dilution that can severely damage long-term shareholder value.
We also have to talk about the physical reality of trading this stock. Robin Energy is listed on the NASDAQ Capital Market tier.
Yes, which is important.
For a retail investor, what does trading on that specific tier actually mean in terms of risk?
The NASDAQ Capital Market, is designed for early stage or smaller companies, and the defining characteristic there is lower overall liquidity.
Okay, break down liquidity for us.
Liquidity simply means how easy it is to buy or sell a stock without changing the price.
Mm-hmm.
On major exchanges with massive tech stocks, millions of shares change hands every minute. You can buy or sell instantly.
But with microcaps.
With microcaps on the capital market, the trading volume is a fraction of that.
So if that 35% pre-market surge reverses, it gets messy.
It gets incredibly messy. Low liquidity is fantastic on the way up because a small amount of buying pressure creates massive spikes.
Right, like we saw Monday.
Exactly. But it works exactly the same way on the way down. If the broader shipping sector takes a hit, or if the market decides the LPG expansion isn't working out, everyone tries to sell at once.
And there's nobody buying.
Right. It is like 100 people trying to sprint through a single narrow exit door in a crowded theater. There aren't enough buyers on the other side of the trade, so the price plummets violently until it finds a floor. It demands a very high tolerance for volatility.
If an investor is willing to stomach that volatility, what does the roadmap look like? Let's map out the catalyst calendar for the next 30 to 90 days. What are the specific events that will determine if the bull or bear case wins out?
The single most critical event on the immediate horizon is their fourth quarter 2025 earnings release.
When is that expected?
That should drop sometime in March or April. This is the moment they finally reveal the House inspection report. The market desperately needs actual financial validation of this expansion strategy.
What numbers do we need to see?
We need to see top-line revenue growth north of 20%, and crucially, we need to see positive free cash flow. Delivering those specific metrics proves the new vessels are actually generating the modeled margins.
What about macroeconomic factors outside of the company's direct control? The broader environment seems incredibly supportive right now.
The macro environment is providing a massive tailwind. We are seeing sustained rallies across major shipping indices.
Due to global tensions?
Exactly. Global geopolitical tensions are physically redrawing traditional shipping routes. Vessels are being forced to take much longer paths around conflict zones, which absorbs global fleet capacity.
When ships are on the water longer, supply tightens.
Or daily charter rates go up. Combine that with the ongoing focus on energy security globally, and RBNE benefits from a rising tide even before they report their own numbers.
And internally, what should we be watching for regarding their strategy in the first half of the year?
In the first quarter, stay alert for any further fleet expansion announcements. If they announce a third or fourth LPG carrier, it proves management is doubling down on this specific niche.
And looking further out.
Looking toward the second quarter, keep an eye out for that first official analyst initiation. If a reputable bank finally publishes coverage and explains this model to the institutional crowd, that is the trigger event.
A re-rating event.
Yes, that rotates the stock from a hidden microcap into a mainstream momentum play.
Let's pull all these threads together. RBNE is an agile, newly independent microcap making aggressive, highly targeted asset grabs in the lucrative liquid petroleum gas market.
Spot on.
They've got smart money paying attention, evidenced by significant pre-market surges. But you are buying into a narrative that currently lacks granular financial data.
You're definitely flying blind a bit.
You are taking on the execution risks of a management team that must prove they can translate these specialized vessels into consistent cash flow without continually diluting their shareholders. It is a high-risk, high-reward scenario playing out entirely in Wall Street's blind spot.
That captures the core tension perfectly. And that is exactly our mission here on the Easy Money Show. To take these complex, under-the-radar market moves, strip away the financial noise, and bring you the most accessible, actionable breakdowns possible.
Before we sign off, I want to leave you with one final thought to ponder. We've talked extensively about RBNE carving out this profitable little niche in the Asia-Pacific gas market to grow their own business.
Right.
But look at the broader chessboard. If you are a massive legacy shipping giant looking at the booming demand for LPG, you could spend years and billions of dollars trying to negotiate and build new specialized vessels from Japanese shipyards.
Which takes a very long time.
Or you could look at a nimble microcap like RBNE that has already done the heavy lifting, operating so quietly, building out this exact specialized fleet.
It makes you wonder.
Could their ultimate endgame be something else entirely? Are they aggressively positioning themselves as a turnkey plug-and-play acquisition target, simply waiting for a legacy giant to swoop in and buy them out at a massive premium to instantly capture that market share?
That is a fascinating angle to consider as we watch this play out.
See you next time.